Now, today we are going to look at the bid and ask, price, explained. The bid and ask, explained. Now, there is a figure here. Now, this is a customer set. No, we have a phone dealer. This is a phone dealer, and then the customer buys the phone from this dealer, and this one, the customer sells phone from this dealer. Now, there is a difference. This is $1,000. This is sale, and this is $1,500. This is ask. This is buy. Now, this phone dealer sells this phone to a customer at $1,000, and this dealer sells to a customer where he buys a phone at $1,500. Now, let's break. Now you see the profit pocket is $500. That is the spread. Now, the dealer setup in financial market, you aren't trading directly with other retail players. You are dealing with market maker or a dealer. The core mechanics. Every quote features two distinct prices. The difference between them is transaction cost. The profit loop. A dealer must always sell an asset for higher value than what they paid to acquire it to remain sustainable. Now, let me explain this, and I tell you more about it. Now, today we are unpacking how money is made on every single transaction. In the forex market, think of your broker not as a middleman matching you with another person, but as a retail storefront, like an iPhone dealer. If a dealer buys a phone from someone from $1,000, that is the maximum purchase price. If they immediately turn around and list it on the shelf for $1,500, that is the retail price. They don't do this for free. That is $500 gap. Is the built-in caution for taking the risk of holding the phone. In trading, your broker does the exact same thing with the currencies. This is how we have explained with the figure and how does it go and the profit pocket itself from the dealer. Now, let us go to the part that understanding the bid in detail. Now, on this we are understanding the price bid. We are focusing on the bid. Now, this is your trading platform. This is sell. This is buy. Now, these are the quote when selling the donors. These are the quotes, and this when buying the donors. This is the quote, and you can see the PPIs is changing. This pip here, it has changed with one pip. The fourth decimal place has changed with 1, because this one is 1.1025 to 1.0264. Now, you click sell to accept this price. Now, the broker's buying price. Now, this is the broker's buying price. These are the prices of the donors when he is selling, when he is buying. Now, bid definition. The specific price at which the market or broker is willing to buy a currency pair from you. See, the specific price at which the market or broker is willing to buy a currency pair from you. Trading action. Trading action. When you want to initiate a sell, short trade, or exit a long trade, this is the execution price. Platform translation, typically highlighted in red or designated under the sell button or commercially platform. Now, let me explain this. Here we are focusing on on bid. We are focusing on this price bid platform. Now, the easiest way to avoid confusion is to look at it entirely from the broker's perspective, not yours. Is looking from your broker's perspective and not yours. The broker is bidding to buy your assets. If you own euros and want to get rid of them for US dollars, you must look at what the broker is willing to pay you. In our quote, example of 1.0, this one 1.02252. Now example of 1.0252. That's lower number present the exact amount of US dollars the broker will hand you for €1. You understand? Now this one, if you are selling, now remember this, if you are selling the broker, this is the amount that he will give you, because now he will be buying from you. Now, in good example of that 1.10252, that's lower number present the exact amount of dollars the broker will hand you for €1. Okay? When you hit that sell button, you are officially accepting their bid. Okay? Now you've understood. Now, let us get to the next point of understanding what is ask price. This one we are focusing on the ask, understanding the price ask. Now, this one seems the same like the other one, but this one is different. Now you see, this is a sell. Now this is your trading platform. This is a sell price. This is a buy price. Now you click buy to accept pay this price. See? Now this is brokers selling price. Now this is the ask. This is the ask. Ask. Now the specific price at which the market or broker is offering to sell a currency pair to you. The specific price at which the market or broker is offering to sell a currency pair to you. Now the trading action, when you want to initiate a buy, long trade, this is a price you are forced to pay. Premium price in the ask price is mathematically always higher than the bid price. Now, let us illustrate this one. Now, let's switch gears to ask price, which is also sometimes called the offer. Again, look at it from the broker's side. It is what they are asking you to pay. If you want to buy euros, you can just pick a price. You have to pay the retail sticker price the broker sets. In our example, that price is the 1.10264. See? Because the broker needs to protect their profit margin, the price they ask you to pay to buy something will always be slightly higher than the price they bid to buy it back from you. Okay? Now, let us look at the calculating the spread cost and see how we calculate the spread cost. Now, let us see how we calculate the spread cost. Calculating the spread cost. Now, here we're going to look at how to calculate the spread cost. Now here, you see it is ask price. This is the price of ask. That is ask price 1.10264, and this is the bid price. This is the selling price 1.10252. Now the spread here is equal 0. If you this one you minus you do this, U minus, you see this is 0.0012. This is a spread cost. Immediate negative balance upon trade entries. Now here is the formula. Spread is equals to ask price minus bid price. The immediate cost. The moment a trade is executed, the account will display a minor floating loss. Because of this price gap, executed the account will display a minor floating loss because of this price gap. Broker revenue. This mechanism represents the primary method retail platform used to monetize order flow without explicit commissions. Finally, let's look at the absolute reality of entering a trade. The spread, entering the trade, that is the spread. If you subtract the bid from the ask, this one, if you subtract the bid from the ask, you get a teeny decimal remainder which represents the spread cost. Now this is the spread cost, which represent the spread. Now this one, the spread cost. Have you ever noticed that the very second you click buy or sell, your trade immediately start in a small negative balance? Have you ever noticed that? You aren't losing the trade. You are simply paying the broker's transaction fee up front. The market has no move in your favor by at least the size of that spread before your position breaks even and enters positive territory. Now, at least the size of that spread before your position breaks even and enters positive territories. Now, this is the last part on how you bid and ask price explanation, calculating the spread. You just pass through this note and understand what we mean. In the next video, we're going to study something else different and follow these steps by steps and get to understand what it is by bid and ask price explained.